If the Fed doesn't control mortgage rates, who does? Last week, Donald Trump and FHA Director Bill Pulte both lit into the Fed chair, Jay Powell demanding deep rate cuts and blaming him for today's interest rates. Trump said we could be at least 2 to 3 points lower, while Pulte saying there's no legitimate reason to keep rates high. We must lower rates. So, Josh, who actually controls mortgage rates? Let's talk about it.
Well, especially coming from the FHFA director who's in charge of Fannie Mae and Freddie Mac, the implication is that it is as simple as Powell going up to the podium last Wednesday and saying, we've cut rates 2% and your mortgage would be 2% lower. Well, we got a preview of that last fall, Jeb. The Fed cut 100 basis points across 3 meetings. And the fear at that time was that the economy was falling into recession. They were feeling they were restrictive and they could take some of that restriction away. So what happened? Mortgage rates dropped 1%, right? Because that's all we have to do, according to our president and FHFA director. But the reality was rates increased. The market had kind of front run that, and we already saw the dip before the Fed cuts. So buy the rumor, sell the fact. The Fed cuts come, and we go, oh, hey, actually, it doesn't look like the recession's coming, and we ended up higher than where we started. So let's start this conversation, Jeb, with super basic. What is interest? Most people don't even understand what interest is. If you doubt that we, or at least Josh, is a full-blown nerd, one of my favorite books is a book by Edward Chancellor called The Price of Time. And that in and of itself is a very good description of what interest is. It is the price of time. So I want to buy a home. I don't have $400,000 to go do it. I have saved $25,000. I'm buying time, a time machine forward to get my house today, but there's a price for that. I need to pay interest. The interest is the actual cost of that money. So no one gives it to me free. There's a margin on top of that. So at any given time, how much people want to profit by lending out their money increases, so that margin can go up or down. But that the price of time, just to make sure that they get their money back in an equivalent amount to today, is really the big point. So we're going to talk about 7 different drivers of mortgage rates. 3 or 4 of them are primary, but let's start. We actually had this number 2 on our list, Jeb, but I want to start with this as number 1 because it really is like number 1 through 10 and everything else comes after it. It's inflation expectations. Why is that? Because if I loan you $400,000 today to buy a house that you're going to slowly pay me back over 30 years, when inflation is high, that $400,000 is worth less when I get it back. When inflation is low, it's worth more when I get it back. So I can charge you less and still hit my profit margin for lending you my excess dollars. So beginning, end, alpha and omega of this, it's not the only thing, but very close to the only thing, is inflation expectations. Everything else we're going to talk about are things that impact inflation expectations to one degree or another.
Now, before we move forward, I have 2 favors to ask. If you're finding any value in our videos at all, make sure you hit that thumbs up and make sure you subscribe to the channel to stay updated on everything that's happening in the world of real estate. And if you're somebody that is going through that home buying process, not sure where to start, just kind of want a discovery call to figure out what the next steps are, you can book a call with us directly using that link in the description of the video, theeducatedhomebuyer.com/start. Well, let's dive in, Josh, and talk about the difference between the Fed funds rate and mortgage rates. A lot of confusion out there. One thing, a lot of people think it's one and the same. Hey, the Fed cut rates. Hey, mortgage rates went lower. Not necessarily, right? So let's talk about the difference in the two. And then we can talk about those drivers of what's actually pushing mortgage rates.
The Fed funds rate is the overnight lending rate that banks charge to lend each other money, and that is set by the Fed. But you are never borrowing at the Fed funds rate. The closest that you get to that is the prime rate. The prime rate moves in lockstep with Fed funds, and many things that you actually do pay on are based off of that. Some auto loans, most credit cards, home equity lines of credit. So a lot of consumer credit is based off of the prime rate, and that will have an impact. So when the Fed cut 100 basis points last year, everyone's home equity line of credit's dropped. Their credit cards got a little bit cheaper. Some auto loans got a little bit cheaper. Student loans got a little bit cheaper. So when we look at that, is there a benefit? There is absolutely a benefit, but it doesn't directly roll out into the economy. So we talk about the 10-year treasury a lot. And the reason for that is over time, that's shown to have the greatest correlation to mortgage rates. Sometimes, like right now, it's probably closer to a 5 to 7 year treasury. But because we always talk about it for the last 50 years through the lens of the 10-year treasury, that's what we look at, because we look at that as sort of a risk-free rate of return. Lending money to the US government is the lowest risk of loan you can make, so you get the least interest on that. So there's a correlation between the 10-year treasury and mortgage rates that reflects the additional risk in mortgages, and we'll talk about what those risks are, but the additional risk in loaning Jeb money to buy a house versus loaning the US government to finance the national debt.
So in short, markets basically set those yields based on expectations. Not headlines, not Fed speeches, not Trump demanding lower rates or Bill Pulte coming out and saying anything. It's based on somewhat market volatility, Josh, and we've seen it over the last couple of years. I mean, hell, back in the pandemic, we saw the Fed funds rate at zero. Banks were able to borrow money from one another at basically next to nothing. And we saw the result of that, right? I mean, we saw a lot of money stimulating into the economy. We saw consumer spending. We saw just all of these different things. Now, Fed funds rates pushing 4.5%. And with Trump saying he expects it 2 to 3% lower, I mean, you're talking 1 to 1.5% on the Fed funds rate, which would absolutely stimulate the economy, but it would also have negative side effects as well.
Absolutely. So market expectations, it's a big catch-all. Market expectations of what? So we started in saying that the big one is inflation, and almost all of the other things that the market is looking forward to and anticipating are things that impact inflation. So when we start with that, the big ones that we talk about that the Fed actually looks at, there are two primary drivers. They have two mandates: full employment and price control. So they want to keep inflation. They have set an artificial number. There's nothing magical about 2%. They've decided 2% is appropriate for PCE, core PCE inflation over the long haul. And we've been approaching that, but we're still well above that. Under 3%, but above 2%. And it had peaked, up in the 7-8% range on core PCE. So when we look at that, the inflation component is the most important. All of the other things we're going to say what the market is expecting, to one degree or another, they also impact inflation. So with that, let's talk about the things that lead to inflation. The jobs, the full employment piece. The Fed wants everyone to have a job, right? In a functioning society, everyone that wants a job, that isn't retired or lives a life of leisure because they won the lottery, needs a job and should have access to a job. So that's what the Fed means by full employment. At different points, that's been considered a 5% unemployment rate, a 4% unemployment rate. Right now we're at 4.2 and ticking up very slowly, but anywhere in that 4 to 5% is a fairly robust jobs market. Coming out of COVID, Jeb, we had got down into the low threes, maybe even got into the high twos. So when you start looking at that, you have a problem. There's not enough slack in the labor market. So if you have a business and you need new employees, you have to take either less qualified employees and pay them what you pay qualified employees. That's a form of inflation because you're paying people more than they're worth. Or to get the good people who are very good at what they do, now you have to have a bidding war with the 3 other businesses that do what you do, and you pay them more. So you're like, okay, why is that a problem? For me as a person, if I make more money, this is great. I can afford my mortgage better. I can save more money. I can do wonderful things. Well, the reality is, and we saw this during COVID, when people get extra money, whether it's a government stimulus check or a big raise at work, we're making it rain. We're going on vacations. We're going out to Applebee's. We're doing all the good stuff. So when we look at it, that's what happened. So inflation got out of control because we had too many dollars chasing too few goods. And there were a million reasons for that. And if we want to talk about, Trump says we'll be paying for Powell's incompetence for years. He may be right, but he's looking in the absolute wrong place. The incompetence was keeping rates really low when everyone saw and was seeing and could foresee that inflation was getting out of control, that we had a very tight labor market, that the government had given away money, that the government had printed money and put more money into the system. You guys probably get tired of hearing us talk about everything being an issue of supply and demand, but it is. The government printed more money. The government took most treasury and mortgage bonds out of circulation by buying them themselves. So those that wanted and needed to buy them as an investment had to pay more, driving yields down. And we had more dollars out there chasing goods. We had limited supply chains. So it was like the recipe, the perfect recipe for a massive burst of inflation, which is what we got. So we had artificial inputs from the government for what? If we say COVID jumped off in early 2020, from 2008, the reaction to the great financial crisis, we had 12 years of different forms of government intervention and thumbs on the scale. So now you say, okay, we're taking our hands off the scale. We're going to raise the Fed funds rate and we're going to let this roll for a while. Well, the short-term response in the market was a massive burst of inflation. So we are now recovering from that. But looking at that, those are the two things primarily. Market expectations is what's going to happen with inflation, what's happening with the job market, what is happening with the economy as a whole. Why do we in the mortgage industry, why do you guys on the live show every Wednesday want to hear, well, what happened? We got GDP numbers today. What does that mean? It would be great to think that the economy can grow at 5, 6, 7% a year without any repercussions, but that's called running hot. You have all of those underlying issues where businesses are doing well. They need resources. They outbid each other for it, whether those resources are goods, whether it's employees, and everything gets more expensive and inflation gets out of control. So when we look at that, we have seen a very extended non-recession. So since the great financial crisis, we have been in expansion other than 2 months at the beginning of COVID. And that again is kind of from this manipulation of the government. But when we're talking market expectations, it's really what's going to happen with inflation, what's going to happen with the jobs market, what's going to happen with the economy as a whole. And I guess you could lump in there, what's the government going to do with monetary policy? Not Fed funds here in terms of that, but are we going to increase the money supply? The market responds with velocity of money, how fast that money moves around the economy, but the government absolutely does control how much money they're putting into the economy.
No, and on top of that, there's the expectation of how the Fed is going to react based on comments that they've made previously, right? So there's this whole, betting being made, if you will, out there with where the Fed funds rate is going to go. At the moment, predicting what I think 2 additional times maybe this year, maybe even 3 now, based on some of the comments that have been made recently. But there's this expectation, and because that expectation is already there, it's more or less built into the market. So when the Fed comes out and does exactly what the market has been expecting it to do, you don't really see the driver in mortgage rates because it's already built in, right? The 10-year, some of these things front run what actually happens. And so when the news happens, people are like, well, why did rates go the other way? Well, we've been talking about it for weeks, for months sometimes, that, hey, this is the anticipation. We know what the Fed's move is. They've laid it out. They've been transparent. And that's what the Fed wants to do. They want to be transparent because when they surprise markets, it surprises markets and typically not in the way that they initially intended. So they like to lay things out. They like to be slow, methodical, and say, hey, this is what we're doing. We want to wait. We want to be patient. We don't want to overreact, because when we overreact, sometimes we get ahead of the market. And what they're doing now is laying behind. And we've talked about it before, but they have a tendency of almost being too complacent in some ways and staying, dormant when they should be reacting, and vice versa. Letting the pendulum swing too far in one direction or the other. So with that, Josh, we've got, other things that impact mortgage rates, which we've talked about, in previous, things. You mentioned the Fed buying mortgage-backed securities. The flight to safety, people buying bonds. We can go into deeper in this sort of thing, but the term premium, which we've discussed, and that's that spread that's out there. And one reason that we probably haven't seen mortgage rates move as low as they probably could have, based on what's happening in the market, because lenders don't want to put themselves in a position where they're going to lose money with people refinancing as mortgage rates move lower.
Well, let's look at each of these, because these are things that you may have heard. So the Fed balance sheet, which you would hear of in terms of quantitative easing or quantitative tightening. So post GFC, they wanted to stimulate the economy. They had already taken rates to the lower bound in terms of the Fed funds rate. So how else can we stimulate actual day-to-day interest rates? We can buy treasuries. So we take out supply. So whatever demand is there is going to have to pay more, push yields down to get what supply is left. And same thing with mortgage-backed securities. So they did that. And if you were around in 2014, you remember this thing called the taper tantrum. the Fed tapered their buying of mortgage-backed securities and treasuries, and the market pitched a fit, and rates shot up 1% in like 2 weeks before sort of correcting. Now, coming out of COVID, we are now in quantitative tightening. So the easing is when they are buying treasuries and mortgage-backed securities. Right now, they are letting them run off. They've stopped doing that with treasuries, but they are letting their holdings of mortgage-backed securities run off. So when an interest payment comes in, they don't turn around and reinvest that. So that impacts through supply and demand what is actually happening on the street, probably a greater direct impact than what you see by a Fed movement. So right now, that's having a negative impact on rates. They could stop and start reinvesting the interest payments they receive on their mortgage-backed securities. That would increase the demand in the mortgage market, and we wouldn't see a commensurate increase in supply, and that would lower interest rates. They haven't indicated that they want to do that yet. It's funny that if Trump and Pulte want lower rates, it's interesting that they haven't said, hey, let's put a pause on our runoff of our mortgage-backed securities. But that sort of leads into the other one, is bond supply. That impacts the supply in terms of, we have a massive buyer, the U.S. government, buying treasuries or mortgage bonds. Well, they also are an issuer. So when the government spends more money than they have, which I don't know if you've seen in the headlines, they've been spending a lot more money than what we actually have. Bombs and B-2 planes and all sorts of things are very, very expensive. So when you look at that, that has to get financed. They finance that by selling treasuries. The bigger the debt grows, the bigger the credit card balance, the more supply there is in the market. And depending on the volume of buyers, if there's less buyers, they pay less for that debt, and it increases the yields. It increases interest rates to you. It increases the interest cost to the U.S. government. So that's a very, very big one that we have right here. Term premium, Jeb, you mentioned it in reference to the spreads between treasuries and mortgage bonds. There's an element of that, but really term premium is across the board, not just the spread between treasuries and mortgage-backed securities. What we're seeing right now is short-term yields, 2-year, 5-year, 7-year treasuries have done better than 10, 20, 30-year treasuries. And the reason for that is all of this uncertainty out over the long run. Is the government going to get their house in order? Are we going to elect some politicians, hopefully from a new third party that pops up that actually is averse to spending and is okay with killing some sacred cows to balance the budget? Because right now, the market is looking at saying it doesn't appear as though either political party in the United States has any interest in balancing a budget, slowing spending. So that means we're going to have risk over the long haul, that I'm okay tying up my money and loaning into the U.S. government for 2, 3, 5 years, not so much for 30 years. That term premium kind of also comes into play when we talk about spreads between mortgages and treasuries. So we follow the 10-year treasury and the spread between mortgage rates. And the common way that that's done is Freddie Mac every Thursday puts out their primary mortgage market survey saying what 30-year fixed interest rates were that week. It's a very flawed study, but the methodology has been consistent. So when we look at that, over 40, almost 50 years, the spread between the 10-year treasury and mortgage rates was about 176 basis points, or 1.76%. So if the 10 years at 4, mortgage rates are at 5.76. We blew out almost 300 basis points, where a 4-year treasury would have been a 7% interest rate. Right now, we've moderated, been right around 240, 241. It's been as low as 232, 233. Matt Graham, guest of the show, friend of the show, he was quoted as saying, we're probably not ever going to see, because we're not going to have quantitative easing come back in the way that it did in the past. 176 is probably not the correct long-term average. It's somewhere between maybe 185 and 215. So we have some room there for that spread to decrease. So even if the Fed funds didn't drop, 10-year yields didn't drop, there are reasons why those spreads have blown out. There's reasons why they've normalized, and they're likely to normalize more, even if they don't get back to where they were historically. So all of these things, if inflation moderates, if unemployment increases and the jobs market weakens, if we get a little bit of a decrease in that, if the government does anything to attempt to balance a budget and decrease treasury issuance, those are all of the things that we should be looking for to say, are interest rates going to go lower in the future, in the near future, versus what did Powell do? What did Trump say? What did Pulte pile on with?
Yeah, I mean, the reality is if we want to see lower rates, we need a slowdown in the economy. Right. But it's twofold. A slowdown in the economy is great for mortgage rates typically. Right. I mean, because, why do mortgage rates go down during a slowdown? Well, the government is trying to stimulate the economy, right? So the Fed funds rate typically drops. You've got, borrowing increases, more money is borrowed, it goes back into the economy. It helps stimulate growth. And so that's a positive. But at the same time, you've got an economic slowdown. You mentioned rising unemployment. It means hopefully inflation is where, close to what the Fed's target is. But as soon as that happens, the recession, if you will, depending on how deep that recession is and how low rates go, that borrowing of money goes back into the economy, and then they risk this whole inflation thing again. And that's essentially what the Fed has been trying to avoid by staying more restrictive, right? The policy's been super restrictive over the last couple of years. And, so in order to see lower rates, you're going to need to see unemployment move higher. You're going to need to see inflation closer to the target. You're going to need to see businesses probably not hiring. And all of these things, again, are great for mortgage rates, but not so great for the economy. And so I think it's important to understand there's two sides to this. It's going to benefit some and it's going to hurt others.
I think of it this way, Jeb. One of Wayne Gretzky's famous quotes is, "I skate where the puck is going, not where the puck is." And that's what the Fed says they're doing. They're trying to look at where the economy is going and project for that. But we can go by their recent past. Again, the criticism of Powell and the Fed should be for the reaction during COVID, not what they're doing now. And if we look back, that can be instructive. Remember the whole idea that inflation was transitory, and not transitory meaning 2 or 3 years and then we'll go back to a lower rate of inflation. Transitory like 3 to 6 months, and this will work its way through the system. When anyone could see you can't increase money supply, you can't directly give money to people, you can't have tightened up the jobs market where everyone's getting raises, on top of the government money that they're handing out, and then on top of that we have supply chains limited where there's not as many goods or places for them to go and spend that money. It was very predictable. And they were not skating where the puck was going. They were skating where the puck was because they thought it was okay today and it would resolve itself quickly. The risk today is that they're doing the same thing. Like no one looking today can say that we're in a bad spot. The neutral rate, you may have heard it called R-star, a really wonky term for where is the neutral rate? Where would the Fed funds rate be that doesn't stimulate the economy or put the brakes on the economy? Depending on who you talk to, it's 0.5% to 1.5% below where it is right now. And the Fed will acknowledge that. So they could cut 0.5% and they wouldn't be stimulative. But what they've been saying right now is there's no issue. There's no problem. We haven't spiked unemployment. We haven't conquered the inflation and got it back to our 2% level. So why would we not continue to be restrictive until we get there? Well, it's simple, right? If you keep your foot on the brake too long, you're going to stop short of your goal. So from that perspective, we saw how that worked out in COVID. They kept their foot on the gas too long and they ran through the intersection and crashed the car. So from that, no one has perfect insight, right?
Well,
None of us.
And to give them credit, right? I mean, recently coming out, like the last Fed meeting, I think June, it was basically like, hey, we're going to pause and we're going to be patient. We're going to wait to see what happens. Fed Chair Powell now in the last 2 days of the conference basically saying, hey, listen, if inflation numbers don't show up in July, then I could see a path where we do actually cut rates in July. So, give them some credit where it's due and to say that, hey, listen, we are watching and we are paying attention. And it's a thankless job. Who would want to be in that position and be in charge of so much and have the criticism on either side constantly? And the reality, not Jeb. We get enough criticism without being the Fed chair, Josh.
And the thing is, the criticism they get is so misdirected. Can you criticize the Fed? There are things you can criticize them for, but the criticism that we see in the press, that's not what they're not political. Like in a hyper political charged world where everyone has a political opinion and it's very polarized, they're not political. They're just going through and doing what they think is the best. They're academics. They're removed from the street. And like all of us, they're dealing with imperfect information.
They don't have street cred.
They don't have street cred, but they're dealing with imperfect information. And their information, you would think, in a data-driven age where we have access to more information than ever, would be the best. But they are still relying heavily on surveys. And as you well know, no one answers their phone, no one picks up. So the survey responses are much lower. So there's serious questions about the data that they are relying on to make some of their decisions and how accurate it is today in the modern world. And many of the things that we look at, Jeb, are real world high frequency indicators that you can see more often and more accurately that are pulled from the data in the economy versus having to do this polling. At some point, they have to have a discussion about let's modernize the whole system and go to actual data measurements versus this polling stuff with unemployment and consumer sentiment reports and all this stuff they rely on.
Yeah, and I think the message here for the educated home buyer crowd is you're not waiting on perfect timing. You're not waiting, for the absolute bottom in rates. You're doing the homework now to be in the right position so that if and when the right home comes up and you're in the right position to buy because it's the right time in your life, you can make an offer and feel confident about it and know that, listen, there's a really good chance at some point in the future there's an opportunity for lower rates, and by coming in now, you're at least locking in the home price so that you can take advantage of lower rates in the future, right? We're still seeing year over year home price growth. It's slowed considerably month over month, but the reality is, depending on where you're located, it's a supply and demand issue to some degree.
Your mileage will vary greatly depending on where you're at in the country.
So this isn't a push to get you to go out and buy a house. It's just, hey, know your numbers, know what you're comfortable with, so that when the right opportunity presents itself, you're in the best spot to take advantage of that. And if Josh and I could be of any assistance to you, whether you're going through the pre-approval process, need a second quote, need a realtor to help guide you in the right direction in your market, make sure you check that link in the description of the video, theeducatedhomebuyer.com/start, so that you can get the process started.
I'll say this, Jeb, the people that we're talking to today that are buying today, they're either move up buyers. That's a very different animal. Something happened in my life. I need to move. But the majority of my clients, probably 60-65%, are first time buyers, most likely like you are. Those first time buyers, it's lifestyle driven, life cycle driven. Something happened in my life, just got settled in my job, just got married, just had a kid, just got divorced, any of those things. If you go back to COVID, it was opportunity driven. We had a lot of that demand pulled forward. People that wouldn't have bought until 23, 24, 25, 26 said, I have to do this. Prices are shooting up and rates are so low that I can afford it. So it is not in any way surprising, with affordability strained and all of that pulled forward demand during COVID, that we see a low supply of homes, but low supply of homes selling, a low volume of homes selling. But what I can say in dealing with people all day, every day, it's my life has got me to that point. I'm settled financially. I can afford this. I want this. I need this. It's the right thing for me to do. And if that's you, that's when you reach out. It's not because you're watching headlines or you're getting your parents yelling at you, you need to own a home or you need to move out of the basement or whatever the case may be.
Absolutely. So if you found any value in today's episode, make sure you hit that thumbs up. If you want to stay educated on everything about the home buying process so that you can become an educated home buyer, make sure you subscribe to the channel. But until next time, make sure you buy right, borrow smart, and build wealth. Adios.
Amigos.